All right, ladies and gentlemen, welcome back to the fastest growing life insurance show on the planet, especially on YouTube. My name is Caleb Guilliams. We got Dom Rufran in the house virtually. And today's episode, we're double dipping today, Dom. We're not only going to have a phenomenal episode, I think it's going to be one of the fans' favorites. I can pretty much say whatever I want. You know, keep me accountable in the comments, ladies and gentlemen. But I also have a debate coming up. It's coming up tomorrow. Obviously, when this airs, it's going to be after the debate. But the debate is around life insurance, whole life insurance and infinite banking versus someone that maybe is a little bit more skeptical of whole life and infinite banking. It's actually with Jim Do. And those of you that may know who Jim Do is, he's a pretty big deal, runs Do Wealth, very well known in the entrepreneurial mastermind community. We're both good friends with Bob and Ben Frazier, who shout out to them. They wrote a wonderful book. It's called Invest Like a Billionaire. Both Jim and I are friends. We both endorse this book. This book's great, by the way, when it comes to vetting alternative investments and deals. And they, wanted to have us connect around this because I think it's a common question that comes up. And so I thought, hey, what if I could like verbally process, you could help me prepare for this thing. But I also think that this type of subject is something that if I'm already going to prepare and talk to you out loud, why don't we just hit record and do it where the our fans and community can listen to as well. So without further ado, Dom, let me know your thoughts, anything that I missed, and excited to dive in. They gave me some questions to go over, and I'm also technically we have 3 minutes each to kind of share. And I will also say, if this episode comes out, or if they get this thing recorded, we'll make sure to have it in the description below. I'm not sure, you might be seeing this before they edit it and all, but we'll make sure that you all get a chance to watch it when it does come out.
Amazing. I'm looking forward to drilling you and giving you the hardest time ever during this prep time. Now, what I think about as we're going through this is I want to be as objective as possible and think about like if I maybe wasn't as educated or I had a different perspective, like how would I actually think about it? Because what I want to do during this time while we're here is I do want to push back a little bit, but I also want to be like, oh, this is really good, or like, hey, maybe not. So I'm looking forward to this. This is going to be a lot of fun. I don't know anything. So just for the record, on the other side of the listeners, I have no idea what Kid's about to throw at me. So we're about to have a great time.
Yeah, here's what I'll say. I've been playing a lot more pickleball, as you know, and one thing I'm working on is when you are at the net, dinking back and forth, you want to make your dinks boring and not attackable. My goal in this conversation is not to be a radical believer and say life insurance for everyone. I want to be able to represent our side well, but I want to decrease the amount of opportunities for someone to attack. And I think because we do content, because I read your lovely YouTube comments for a living, I feel like we have a pretty good, I think we're a lot more aware. I'm a lot more prepared just by default than someone that might not, do YouTube videos or talk for a living. So I think with that,
I'm just saying that because of our last episode. If you happen to watch it, if you didn't, go to it, scroll to the Q&A, and you can see Caleb with his little spiciness in regards to the Q&A that people were for sharing because of the comments that they left.
It's been fun. So, I mean, our videos are getting on the And Ask channel. We're getting good. We're getting good views. I'm very pleased with the feedback and the comments that people are making. So, and obviously this will be after the fact, but I would love to hear your thoughts. Because there's a lot of different angles that you could go into when it comes to the debate, and the angle that I'm going to go into, so I'll just kind of give you an overview of kind of how I'm going to get started, is my thesis is life insurance is not an investment. So right then and there, I'm taking away lots of opportunities to smack the ball in my face. So life insurance is not an investment, but I do believe life insurance, when set up and used properly for the right person, can make your financial situation better by increasing the jobs that that it allows your wealth to do. And so the essence is, and this is another area, is it's just like, if it can, you should do it, and if it can't, you shouldn't. And obviously everyone's going to agree with that, but if something can make your life better or more efficient, you should do it versus not. And so my talking points are going to also be the following: that I'm not endorsing insurance in general. I'm not endorsing IULs, and so that the even the idea of debating IULs, a lot of times it's predicated on an illustration that may or may not be true. That's fundamentally different than whole life. Yeah, whole life may underperform an illustration, but you're not. There's not some shenanigans in a whole life illustration if done properly with a great company that is going to be, misleading kind of deal. I feel like it's way more truthful in even the whole life versus IUL. But I also want to acknowledge, like, life insurance has been oversold. Life insurance can have zero cash value in the first couple of years. That can be terrible. It can be very unflexible. It can be high commissions. Also, there's a bad rap of insurance people trying to be like your holistic planner and trying to be like, I'm going to give you planning advice, and yet they're just looking through the lens of insurance. I'll be the first to say that that's not a good look, I think, for anybody, and just acknowledge that. But also to acknowledge, like, life insurance a lot of times gets dunked on, and a lot of times because of the bad rap, people throw the baby out with the bathwater. And life insurance, while it does not give you cash on cash arbitrage, while you'll most likely always earn in cash value lower than the cost of borrowing, when you factor in all the other jobs that your life insurance contract does for you, that is going to be a greater result than not having it. In other words, if your life insurance IRR is 4% and it costs you 5.5%, if that's the only thing that you cared about, Dom, it's an equivalent of you putting your money into a negative 1.5% savings account. No one would do that. Why would you do that? A negative 1.5 savings account? Like, I'll just put my money in a checking account and at least get zero. But what we're not factoring in is all the other benefits that you're getting that are not factored in, like the permanent death benefit, like the tax advantages that life insurance gives you, like the creditor protections, like the fact that there's safety, like the fact that you get all the benefits that I'm talking about and get built-in ability to collateralize against your cash value and all. And so that is the thesis around where I'm going to be heading. And I don't necessarily think they're going to let me show illustrations, but I also just want to acknowledge a typical policy versus like how overfunded policies can work. And then, acknowledge the pros and cons. And then if we get a chance, talk about the IRR and include, I'm not going to touch fees, but include cost of insurance and taxes. And just those two alone, you'll bump up a greater death benefit. The cash value will be, the equivalent IRR will be greater than the borrowing rate. And that alone, just those two benefits alone, should put life insurance on an equal field. Because the last thing I'll say is, if you could put your money into an account, Dom, that gave you positive arbitrage at value, like pretty much guaranteed, you would do it all day long. If you could put your money in a place that guaranteed that you got 6 and it costs you 5 to access it, you would put as much money as you could. Now, this should be clear, insurance does not, whole life insurance does not do that for you. But my argument would be the benefits that you get do. So while you don't get cash on cash arbitrage, the benefit arbitrage that you get does happen. That needs to be talked more about. And most people, when they're talking about insurance and infinite banking, totally miss that. And we're focused on bad math, talking about compounding versus amortized versus simple interest. And as a result, anyone that really, really knows what they're doing can call BS on those talking points. And so I'm going to try to avoid those, but still be able to justify like why insurance can be such an amazing asset. So that's the thought process. Would love to hear your thoughts on like my angle. And then I also just got 7 questions that they're going to potentially be asking, and we can walk through that. But talk to me about my monologue.
Amazing. So I personally am not a big content consumer, and just being busy running a company, content is very limited in what I choose to watch. And it's usually not around like financial strategies or financial influencers, especially as of late. Jim Do is a name that I've heard of. I didn't know what he looked like. I didn't know what his philosophy was. I didn't know anything about him until like just now. And I ran through ChatGPT. I said, hey, like, what is Jim Do's philosophy? Before I share what I read, I would love to hear from you what you know and see if they match, because
Yeah.
I think that'll give me a better angle to give you feedback before, if you're talking about a Dave Ramsey versus Jim Dude, they may be two completely different sides of the equation. So therefore your argument will differ depending on the person who's
It's
coming
great.
to you.
The Jim Dude's take is going to be that his whole spiel is family office concept, and that you don't need to be a billionaire to have a family office, and you should have someone in your corner that ties everything together. You should have someone in your corner that's a fiduciary, that's not getting paid on the products that they're peddling you, but that can tie everything together. And so he's, been hard on insurance, again, rightfully so, and is not a fan of infinite banking or putting too much money into insurance. But I do know for a fact that they have done insurance in the past, so I don't think they're anti-insurance completely. But I think it's a lot of the same talking points that we see when it comes to like, hey, it's a bad investment. It can be overpitched. And there have been a lot of bad examples of people that, again, are insurance people that try to be maybe someone's advisor and maybe are too heavily pitching insurance as like a retirement tax-free income kind of deal. So that is that's that. He's again gonna go back a lot of times to the fiduciary convo. He's gonna go back to having someone in your corner. The problem with that argument is it's totally true unless a fee only or your fiduciary doesn't see the whole picture. So it's like you could play the moral high ground to say I'm a fiduciary, but what do I care about? Who actually gives you the better outcome or result? So I like the pitch, but then the question is, if you get 100 fiduciaries in their same room together, you're probably not going to get all one answer for everything. So that tells you the fiduciary thing in itself is a cool thing to talk about, but what does it actually mean when it's all said and done? Well, someone could say, well, someone could sue you. Well, that's cool. Like you are held to that standard, but fee-only advisor doesn't necessarily mean you're doing the right thing, even though it's easier to take the moral high ground to say, well, I'm not paid a commission, so I must be doing the right thing for you.
I'm looking at just more of the what ChatGPT says, and I'm starting to now just like advance to some of his websites and his books and things like that. So this is me getting real life data as we go listening to you at the same time. It's interesting to me because with least it's what ChatGPT says is that he has a philosophy that is more aligned, I feel like, with what we actually believe in a lot of instances, and that he prioritizes like guaranteed income and protection and eliminating risk more than anything. And so, you know how Dave Ramsey would like say, hey, shoot for the stars when it comes to the market, just put your money into, after all your debt's paid off, put it into mutual funds, et cetera, and go chase the rate of return. He believes more into things like pensions, annuities, guaranteed income streams, and things along those lines, and doesn't believe that higher returns equal and solve retirement planning. And so if that is true, which I am curious if you know if that is true or not.
Yeah, I mean, part of what they told is like they just tell entrepreneurs to stop investing in dumb things. And we laugh at that, but like by default, they save people a lot of money by just doing their due diligence, because a lot of entrepreneurs invest in dumb stuff.
So if that's the case, his philosophy is literally advocating for how life insurance works in a lot of ways, right? Because it's doing the things that he says, protection, guaranteed income, limiting the liability of the risk, having a set plan for what you know is coming, right? All of these things. And so while you shared earlier, like your side is coming from like, hey, this isn't an investment, great, which should validate what he believes as well. Like you shouldn't be putting money into quote unquote crazy investments. And the idea of chasing the rate of return, same across the board. And so I think by almost going to his side versus like being in, this is what life insurance, like it's this tool that does like many jobs, right? Great. It can do many jobs. It's awesome. But I think almost going to the point of like what he believes in, and this is what life insurance does, may have more ground to stick on than actually talking about it compared to any market asset.
Yeah, no, I think by saying it's not an investment, what I'm trying to do is try to get them to either agree that we're either comparing this to a high yield savings account or a bond with liquidity. Am I off on this? Like, we're not like, we can't, it shouldn't be compared to an investment because it's.
Yeah. Do you know his takes on why he hates life insurance then?
All the points that I mentioned, he said all like the high commissions, a lot of times illustrations can be super misleading. I'll just even share with you a message that I got indirectly from him. And this will just give you kind of like a taste of a little bit. So I sent him some pre-work and he's like, hey, I got no problem with this except I need time to review. I sent him some illustrations just to, I wanted to be like as upfront as possible to be like, hey, if I'm going to be referencing something, I'm going to be sharing this side. And, he just said, we went back and forth and he's like, I totally understand. In my experience, policy illustrations are loaded with assumptions and disclosures, and unless exposed and discussed, can create a story that may or may not be true. What does that have? That has IUL written all over it. Now, I'm not, again, I'm not trying to say that him and I both agree, because you could, I would say the same thing. And here I'm being like, hey, Jim, like, I'm using a whole life insurance. Like, I've sent you 3 whole different companies that are all solid rated whole life. And yes, can there be some shenanigans? I'm trying to think out loud. Like, I think the only thing could be like the dividends could be lower, but like, that's it. We're not there can be a lot more shenanigans in IUL policies. And to his defense, they're like having people avoid what maybe Kyle Busch. I think if Kyle Busch was a client of Jim Deuce, he may or may not have gotten into the disaster that he got into with the insurance company. And so, to their credit, I agree with their premise.
Amazing. I think that he may disagree with the infinite banking concept and how the policy may be used, and like borrowing an arbitrage for some type of alternative asset. That may be a debate that just based off of philosophy. And if his whole thing is like, don't invest in dumb things, right? And he's an advocate for the book, and he believes in more guaranteed income type of deal. Well, then I think that one will just be just a philosophy and view of life, and just like, okay, you shouldn't do that. So I don't know if that infinite banking itself is actually an argument that could be won over. But from the idea of like the debate of using this as all the things that we talk about outside of infinite banking, such as like the volatility buffer, pension maximization, income in retirement, cash flow, tax advantage, like all of these other things, I think he may resonate really well with it when we're looking at it from that lens, just based off of what I'm seeing, right? So this is going to be...
Yeah. Again, I think it's all predicated on if the policy's designed well. I want to give him the benefit of the doubt and say they've probably seen a lot of bad policies, and I'm, again, giving him the benefit of the doubt. I don't know if he's ever seen an actually max-funded policy from a really solid insurance company that's whole life, with a whole life chassis. I don't know. I'm giving him the benefit of the doubt to say maybe he's never seen that. And you're totally spot on. The point that I'm going to make, and I think we're going to probably disagree, is I'm going to say we could potentially disagree on the first couple of year trade-offs. That will be a con that I'm going to acknowledge. But like, let's say whole life insurance long-term gives you an internal rate of return of 4.5. The illustration that I showed him is almost 5% long-term. The loan rate at this said company is 5.3 right now, but I think we are mature enough to say that's going to potentially fluctuate. At the time of this recording, though, the Fed just dropped interest rates. So the idea of interest rates going up is not, it potentially could go down, probably will stay the same. And so the question would be, from a cash standpoint, does it make sense to put money into an account that's only earning 5 long-term and paying 5.3? The answer is no. Doesn't make sense mathematically. But it doesn't take that much manipulation, I say that in a kind way, of looking at taxes, looking at the cost of insurance, looking at some of these other things to actually justify the arbitrage. And then it goes back to the example. Jim, if I had an account that you could guaranteed earn 7% and have access to money at 5.3, you would take that all day long. Now, the difference is going to be if you actually value the death benefit, if you actually value some of these other things, if you value the idea of a better bond, you may not put a value on any of those things. And as a result, then you probably shouldn't do this strategy. But if you actually value these things, and we can get to the, conversation around if you could earn, 7% benefit, would you do something like that? I don't know where infinite banking would be a turnoff. That's where I'm going to try to get with the conversation. We may have disagreements, but what I am going to acknowledge is that you're not, from a cash on cash standpoint, you're not going to get there. That's where a lot of IUL, their whole pitch is around like arbitrage and income and all. I'm not even going to touch that because I think it's not a great argument. I'm just literally going to touch like insurance is a contract that I believe long-term gives you more benefits and gives you cheaper access to money. And then infinite banking is not weird. It's just like, okay, what are you going to use your money on? And then also shift to like, yeah, people are saying like buy cars and all these things. And then just go to like, if you're going to borrow at 5.3%, you should make sure whatever activity you're doing is greater than that. And I actually think he's going to pick up on that way faster because he's not going to get bogged down with some of the infinite banking stuff. Now, will this conversation, for me to be able to actually lay that out, will I actually be able to happen? And he might disagree on like, I don't believe 7%. Like, I don't believe insurance is that. But then I'll just literally be able to be like, okay, well, what tax rate do you want me to use? Capital gains. Okay, let's use 15%. 15%. Okay, right there. Boom, we're over the 5.3. Okay, do we want to factor in cost of insurance by term at all? Yes. Okay, those two factors alone, we're already over, and we haven't factored in all the other things, including a permanent death benefit. So that's like, that would be ideal scenario if we could walk down this. We could disagree, but my hope would be that someone could watch that and be like, okay, I'm getting that. Now, a big pushback to that could be like, hey, I'm 65. I don't have 30 years to get my IRR up to high fours. That's fair. And so that's where it's like, that's where you have to go back to. You may be in a situation where you compare the pros and cons, and the cons far outweigh the pros. But again, the more I learn about the jobs that your dollars do, I actually do believe that is an angle that I should use. But I agree with you around like, I think we're going to be speaking each other's language, because neither of us are saying go try to take big risks, try to get high rates of return. Because I know for a fact that he's very disciplined in that. And by the way, they do a great work for a lot of people. I know many happy people that have worked with Jim and their team, and they have nothing but great things to say.
Amazing. I love it. A couple things that I just have written down here, just maybe to consider, is the first year, you said he may not agree because of the early cash at the beginning, right? I think if he's looking at other assets, potentially such as like annuities and things like that as well, and that's what he does actually believe in, you'd have to get clarity on it. There's surrender charges, there's other things that are like involved within that. So I think that his lens is more of a long-term lens. And he cares more about like the cash flow and income and retirement. You're not going to care about income, within 2 or 3 years of your life, right?
Yes.
Of when we're starting. So
perfect example, alternative investments, a lot of oil and gas, a lot of these other things. Your money's locked up for 2 to 6 years.
Yeah.
So it's actually, if they're gonna take swings at that, that's an acknowledgement. Now the pushback to that, I'm trying to play devil. I'm trying to be as fair as possible here. Is yes, Caleb, but that's an investment, whereas insurance is not. That's valid. It's super valid. But we're also the worst year, the first year in funding. If we can get 85 to potentially 90% of your cash available, like that's not 100%, but it still is pretty valuable if you're able to think long term and say, I'm only giving up temporary access to, 15% of my capital, and it goes down year by year. And in year 4 or 5, you actually have more money than what you've put in. So it's a very temporary thing. And it's not like we're saying your money's locked up for the next couple of years. And so that might actually be an example I use, is like, there's some investments that are being pitched that you have access to none. And so that needs to be factored in.
Yeah, and I think at the end of the day, it doesn't matter if you call it insurance is insurance and investment, or insurance is an investment. What matters the most is actually the result that's actually happening, right? You cover the names up and like, what does they do?
Totally.
And so, that's what matters more than anything. And so, no, I think that's good. The other side is like, obviously, if you're going to use this for infinite banking and you're going to leverage for other opportunities, for other investing purposes, you're going to borrow against and use it. But again, if it is used for more of like the income perspective, there could be a simple, normal conversation to be had. It's like, hey, like we can also use this without taking the loan function, and this can operate like a normal investment that you're used to, right? So that's just like another, I can take actual distributions still, income-free, tax-free, whatever you want to call it, without paying anything because that was my contribution, right? I can take up to my basis. And then after that, one of the most efficient ways is to then take a loan against because of it. So that's just later on in life. That's usually the strategy afterwards.
Well, and one of the beautiful thing about the loan provision is if anyone says that you can get a better rate of return, it's like, perfect. How confident are you on that rate of return? 100%. Awesome. Why don't you take a loan against your life insurance policy and get that, And then, but you're totally right. You don't need to do that. It could act as a super bond. And I don't know if Jim has ever been shared that whole life insurance could be a better bond. I'm going to bring it up tomorrow. I don't know if he's a fan of bonds in general, but I would imagine he's a fan of some type of diversification. I'm sure he's familiar with the bucket strategy and volatility buffer. And so as a result, it would be an interesting thought around maybe don't even. The thing about infinite banking is all you're doing, you're storing capital into a whole life insurance policy that gives you access to capital. It's not, there doesn't have to be anything weird about it other than, wouldn't you rather have access to money versus not?
Yeah, true. And the other thing when it comes to the philosophy, Dave Ramsey, he pushes for like rate of return and mutual funds. So his whole thing at the end, we have generated so much wealth, right, that we can self-insure for ourselves because we've chased this high rate of return and we've essentially accumulated enough, dollars, bucket of money to self-insure if something bad happens. I would feel if you go down the path that's a little bit more on the conservative side, and you care more about the income side of things, you don't necessarily have the same type of resources in theory to be able to self-justified self-insurance indefinitely without a permanent death benefit. And so term insurance is obviously great for the protection of it, but like if you're going down this side of conservative for a lot of time to search for income, well, you didn't chase for high, so you can't self-insure. So the permanent death benefit becomes even more powerful of an asset. And if you don't believe in permanent life insurance, I don't know if he believes in permanent life insurance as a whole or just doesn't believe in infinite banking. All right, and I think that's where, for you, getting really clear on like, what does he know? What does he actually believe? And does he actually just believe it's an IUL that he knows? Or is it terrible policies that it's designed?
Right.
Is he actually a fan of life insurance? He's just not a fan of permanent life? Like, those are the questions that, if you know, will help you obviously be more prepared. More than anything.
I wholeheartedly agree with you. And I want to transition over to the questions that they sent me. They're not saying that these are the questions, but they're just saying that these might be coupled. And the first one's relative, like just very much relevant to what you just said. It says, what are you really buying? Is whole life insurance a flawed product? Or is it a legitimate financial tool that's just often sold poorly? It's a great question. How damaging is a poorly structured policy? Well, that's where we can talk about, let's talk about that. I've heard through the grapevine, never heard it from his mouth, that, Do Wealth has referred people to IULs. Not sure if that's true or not. We may have just a fundamentally different opinion when it comes to even like, what does a poorly structured policy? If we're talking about infinite banking, it's not that IUL's bad. I just wouldn't put that in. I wouldn't talk about IUL when it's coming around with this philosophy. So that might be interesting. And then, can the average consumer realistically tell the difference up front? Shout out to us and some other people. I think outside of our content, the answer is no. But I think right now there are resources out there. If people really wanted to know, there's literally we will do a product. A policy review for people. So I mean, if people are actually looking, hopefully the answer is yes, but the average person, the answer is no. They don't really know the difference between a super optimal design policy versus a mediocre one, other than the fact that there's people making content and there's people available for someone to do due diligence, but you and I both know that most people aren't going to do that. Most people have no idea where to start or how to really evaluate whole life insurance. That's why we've built The Vault. It's all of our best life insurance resources and educational tools all in one place, all for free. We have calculators, handbooks, crash course, deep dive videos on numbers. If you want to learn more, click the link in the description or tag comment below to unlock The Vault. All right, back to the video.
And the other challenging part is you can have a super optimally, quote unquote, designed policy on paper, such as the Bush situation, and still fall apart. Because the Bush situation actually showed like $700,000 of income on illustration paper year after year for like many, many years. And it still fell apart due to all the other things that came with it. And so there comes with more education even around just like, all right, is this optimally designed or not? It's just like, making sure you understand how to pay your premiums, making sure that it's important that you do. And if you don't, what is my minimums, maximums, the flexibility around it? Can I back pay to essentially overcome this if I don't? Like there are some small nuances that come with it. And so I do think, to your point, it is important that people work with people that can help educate them from top to bottom, not sugarcoat anything, not oversell it, and essentially just tell it exactly how it is. And so, but I do think starting with poorly structured, like what is the reason why we want this, and then design it accordingly. Like that is step one, because you know, we also have worked with people who really do just have a massive estate issue and they need a massive death benefit. And a poorly structured policy could actually be an infinite banking and asset high liquidity policy in that instance, because
Exactly.
it wouldn't solve the issue that you're trying to solve.
Exactly. Glad you mentioned that. I think in the light of infinite banking, though, if someone wants high cash value, then there's some basic things that people should be aware of. And if you only have 50% of your cash value, it's pretty much a guaranteed that you're not optimizing for cash value. But it might be you might have the best policy for you, but you can't tell me that you're optimizing for cash value if you have 40 or 50% cash value in the first year.
True.
Second question. These are all run-on questions. This isn't, yours truly. This would be how I would run this thing for sure. For those of you that have listened to any of my podcasts, I ask 10 questions in one. But this next one is, who is this actually for? Who is whole life insurance really for? How does the strategy shift if you start later in life? It's a great question. Bob is not a spring chicken, so it could be like, hey, he might be asking for a friend. Like, does it make sense for someone like me? Can whole life be used to build generational wealth through a family trust or otherwise? How does that compare to strategies that don't use whole life insurance policies? So how would you go about this?
With all of those questions, or are we starting with
how would you if someone just threw all that on you? There's really two questions. Who is it for?
Yeah.
And then talking about what the Rockefeller concept be, and like, could you use the Rockefeller concept without life insurance?
Amazing. So the first one is, who is this for? Now I'd love to hear your solution for the older one, just so you can start thinking about it. It's like, someone's a little bit older, is this for them? While I get my answer.
Cool.
So first, who is this for, right? Well, one, you have to start with the person that is actually educated and understands this concept, and understands whole life in general. Like, that's where we have to start. And so we then have to start asking enough clarifying questions to figuring out who the person is, where does they want to go, what are they trying to accomplish. There's 2, potentially 3 different buckets of people after we ask enough questions to figuring out who this could be for. They could be the person who's trying to maximize their side of retirement. So that could be one person for an income perspective, and they value a legacy from a death benefit perspective. Or 2, an entrepreneur that values liquidity and control to be able to use it for other opportunities, whether that's investing or whether they're business. If they are using it for either or, you can design it still for high liquidity because you want to maximize income later down in retirement, or you can maximize liquidity because you want to maximize control to get more dollars to go invest into more things. So when it comes to the retirement maximizer individual, it could be used for many different strategies. I think it just gives them the optionality, the flexibility, right, to be able to use it for a volatility buffer, be able to use it for income later down in life, be able to maximize their pay down strategy because they get to access their quote unquote death benefit while they're alive. They get to use all of their funds here, now, today, whether that's their markets, their real estate, pay it all down, spend it all. knowing that they still get to pass something down to the next generation. There's lots of strategies that can be used for the person who wants to maximize their later on in life. Now, for the entrepreneur, it's just a better alternative to a savings account that they could access, control, use. They get tax advantages and the 15 plus other advantages that come with just having life insurance as a toolbox to making sure that they have less risk, less volatility, and more certainty in their life. If those are two people, if one of those two people are a person, right, which is probably a majority of people, you also need income to fund. That's important as well. If you have the income to fund and you're one of those two people, this would likely be for you when it comes to who this would be for. The third one, when it comes to, before I go there, because now you're going into the whole, Rockefeller box method, et cetera. Let's start with the question I left you first, because it's like, who is this for, right?
So the older thing you said, I mean, in summary, it's for either entrepreneurs, people that care about retirement, or legacy. It checks a lot of boxes, right? And so then the question is, would life insurance actually benefit you in those three categories? It's yes or no. Same thing I would do if someone's older. If you're 70 years old, okay, what is your goal financially? And then the question would be, does life insurance help you better accomplish that? I know that's going to be kind of a cop-out, but that's how you should approach it. You can't say, yes, it's going to be great. Well, I don't know. I haven't seen the whole situation.
If I'm an older person that's like still in massive like wealth accumulation phase, do you think that that's a decent, like if I'm 60 and I'm still trying to build for retirement, is life insurance
all you care about, if you're 60 years old, you don't care anything about legacy, all you care about is a net worth number, the answer is no. You're not going to get a higher net worth number. If you care about income and you maybe want to retire at 65, 70, the answer might be maybe. It might be like, okay, well, maybe you can fund life insurance. We lock in a permanent death benefit. The permanent death benefit alone could unlock other assets, but we could still overfund this policy. And so the cash value could also be used to invest in alternatives. So the answer is the death benefit needs to be valued. If you don't value the death benefit, it should always be valued. But later in your life, if you don't value the death benefit, the answer should always be no. So even I'm not reading between the lines, but if Bob Fraser, he's like, hey, I've looked at the whole life insurance, and it's just never made sense to me. Well, I guarantee that there's not a value on the permanent death benefit. Like, let me rephrase that. There's probably a disconnect on the value of the death benefit, because I too, if I didn't care at all about the death benefit, I'm just looking at the cash on cash arbitrage. I've already straight up told you that infinite banking does not give you cash on cash arbitrage. So I can see where it can be frustrating, because people pitch you the world and then you're a smart individual and you look at this and be like, someone's lying. So yeah, I'm with you on that. And I think the family trust thing is pretty self-explanatory. It's like, you can do that without insurance. So it comes back to, what does insurance, it goes back to the same framework as, does insurance actually better the ability to pass on money to the next generation? People like the Rockefellers created a system of buying insurance, but you definitely don't need to do that. And trust can allow, inheritance to go back into the trust. I think insurance just creates maybe a little bit more ease, maybe creates a little bit more guarantees and structure. But for you to say you can't build generational wealth without life insurance, I think would be disingenuous.
Agreed. It definitely is just a tool to help make it easier, in like generationally, for sure. Definitely can do it without. In regards to the older folks as well, my headspace would say, unless you have a massive amount of money that needs to be redistributed and you value the death benefit, and redistributed as in like you have so much money into a bucket that's creating so much uncertainty, that needs to be redistributed to a place that gives a little bit more certainty that you can then use for income to create like volatility buffer. Because, if you look at like wealth building cornerstones and like the theories of using them together, the market-based assets, the retirement, and insurance, they really have a target audience of two people that are like already in retirement or a couple of years right before it. And being able to find enough assets and income to be able to fund a policy to make sense would be the only justification in around a concept like this, because you can still actually take income and use it as a volatility and have a high enough death benefit to matter. If you're using infinite banking in my mind for wealth building at that age, I just think it's irresponsible, doesn't make sense, and you just shouldn't. You don't have enough time on your side, and quote unquote, the arbitrage that you're chasing just isn't going to work in that scenario. In 99% of the cases. So I chuckled a little bit. I know I don't know how many more questions there are. It's just because like every time I hear the word arbitrage now, I just kind of just laugh, just because it's been it's a heavy topic as of late.
It's a heavy topic.
I don't know if you guys watched it.
Yeah, no one says that. Oh, you've been in the trenches when you say that.
Caleb and I had a little disagreement. I think it was 2 episodes ago, in regards to just like this concept of arbitrage. And I know Caleb just did an interview with another guy. And they talked about arbitrage.
Chris Noggle. Chris Noggle is the other guy. Just stay tuned for that. That is please go watch that and bail me out in the comments. Cause I told Dom, I'm like, I think I have a home run here, but who knows? I think that a lot of times I have home runs and they're fly balls that got caught. So, right. So
that's what happened though, is we had the little debate, and then we had one person comment on our little argument, and that person bailed me out. So he was on my side.
Yeah. I think he was throwing you a little life rat. I feel like it was a pity comment that he was pushing out. Okay. Number 3, cost versus value. Why is whole life, I'm assuming that whole life, so much more expensive than term? What are you actually paying for in the early years? How long does it take to break even? Is the lifetime guaranteed worth the upfront cost? I think these are a lot of basic questions. I mean,
are you both answering this question, or is it just you?
They only have an hour scheduled. I'm gonna have buffer because this could take us an hour to say hello. There's a lot here, but I think it's it's pretty easy to answer. It depends.
Yeah, for us.
If we're looking for a properly structured, I'll be answering that. The lifetime guaranteed worth the upfront cost.
That's what I want to know, though. I want to know, like, is he actually going to answer these questions? Because if he's going to answer these questions, that means he's sophisticated enough to understand life insurance.
Yeah, maybe I should. Maybe that's what I should do. Jim, why don't you answer that? Jim,
seriously, no,
because you answer these questions and then just see what
arguing that life insurance. Exactly. Yes.
Yeah. That's actually
arguing
really good.
Life insurance is not a good tool, but not understanding it, I think, is in any form. Like, if you don't understand how the tool works, but you're arguing that it's terrible, like, I think that's
should I put a little sass to it? I'm gonna let the CFP Fiduciary answer this question. Jim, all ears, buddy.
I think that's
Jim. If you're watching this, I have the utmost respect for you. I really do. But yeah, So I think that will be good. You're totally right. I think the best way to go about this would be like, Jim, before I answer, because I have receipts, because I literally have illustrations that I could pull up today. So don't be giving me this. What I want to cut out is this whole like. I want to be able to fact check people in real time if they're like, because then it's a great commercial for us. Most insurance policies don't break even until year 12. Okay. Hey, hello, I know a way to make it break even sooner, a lot sooner. So I think this will get, and I actually think we're going to end up agreeing to be like, yes, this is a problem with insurance. So that's great. And just for the record, I'm just going to do actually break even, not the whole annual break even, because I feel like that's another way to just kill credibility. The whole, annually, it's like that's actually true. But if you're actually in a debate, it's a really poor. I
think it's good to know when you have it, because it's like, if you're going to quote unquote think about canceling your policy and you're already past that, quote unquote year where you're making more per year, you'd be dumb to do so, because you're now post quote unquote putting $1, getting more back, even if you haven't broke even fully, right? But like, if you're doing a debate, I do agree with you that it doesn't add much credibility. Like, should I get this at the very beginning or should I not? Yeah.
This is actually, you could help me out here with ChatGPT. Here's the question: cash value and liquidity. What is cash value really? I actually think I would love to know the answer to that, because what is technically cash value really? I think it's a obligation that the insurance company has to you, but it's definitely not your money. If we want to be really technical, it's not your money. It's the insurance company's, like, I don't know. I would be curious to hear. And then the next question is an investment, a savings vehicle, or something else? Are policy loans a feature or a trap? Oh, that's a great question. How valuable is the borrow, sell, never age out? I don't know what that means. Borrow, sell, never age out. Do they mean borrow, buy, borrow, die? It's interesting. Pitch compared to a cheaper alternatives. So what's technically the answer to what is cash value?
So cash value is, the real definition, is the contractual guaranteed accessible equity inside a permanent insurance policy.
I like that. The accessible, the what did you say that again?
Contractually guaranteed accessible equity inside a permanent life insurance policy.
Cool. Can you shoot me that via either an email or WhatsApp? I definitely want that in my notes so that I can sound very sophisticated tomorrow. Be like, actually, let's get the real definition here. So yeah, that's great. I think that this will be a fun conversation because I'll be able to actually explain philosophy around policy loans, that we really should separate the policy loan feature from the internal versus external. And so I'm good moving on. I don't know if there's anything that you wanted to follow back up. I don't know what borrow, sell, never age out. Do you want to look up what that means? Borrow, sell, never age out life insurance pitch.
All right. What is borrow, sell, never age out life insurance pitch? The borrow, spend, never sell, never age out life insurance pitch is simplified wealth strategy narrative, not a technical product feature. It borrows language from the broader buy, borrow, die concept. It adapts it to the permanent life insurance. Here's straight, no hype. The pitch claims that properly structured permanent life insurance lets you borrow against cash value instead of selling assets, spend loan proceeds tax-free, never sell appreciated assets to avoid capital gains, 4, never age out of access to capital or income. So it stands for an acronym to just borrow, spend, never sell. And
so it's close to buy, borrow, die.
Yeah.
Borrow, buy, die.
Buy, borrow, die. It's essentially the same.
Borrow, die. Okay. Yeah, I'll be able to explain that. I think it's a interesting concept. Don't necessarily. Yeah. I'm. I think it's an interesting concept. Definitely would not pitch someone on that concept. This is why you should do it. But I think it's a feature that gives you an option. And one of the things that I will say is more options are better than less options. And I would imagine people would agree with me on that. But we'll see. So, okay, then the next question is opportunity costs and taxes. Here we go. This is where loading up for the home run right here. Once you factor in fees and lost investment opportunities, does whole life really stack up against term life plus investing? Or is that the wrong comparison? Is a tax scenario, in what tax scenarios does whole life actually win? These are great questions. This is where I'm going to try to pivot to the concept around the calculator, around let's just factor in.
Let's use this calculator that I personally built.
I floated this thing to I baked the numbers in my favor. Yeah. But no, that's the whole buy term and invest difference is predicated. The whole life insurance conversation is very much predicated on this concept of buy term invest difference. So I think we'll be very prepared for that. And I will be ready to use capital gains. But I think if we're being fair and we're saying that this is only going to be for the top 20, 30, 40% of people, then we should maybe use higher tax rates. And however high tax rates we use, I think it's going to be tricky, because if you're working with really, really wealthy people, tax rates are going to be a lot higher. That needs to be factored in. Obviously, if you're working with someone that is paying no in tax, the tax benefit of life insurance is not as valuable. Though you could say it's really valuable if they have upside, if they believe in themselves, because you could stuff money away, really costing you nothing. And then as if and when taxes rise, and that's another thing I'm not going to mention, but maybe I'll mention it. But the whole idea of potential taxes increasing, there's benefit of getting some of your money not at risk of that.
Mm-hmm.
Okay, here's the one that's gonna be home run for Jim. Jim's gonna like question number 6. Incentives and conflicts. Are high commissions skewing the way whole life insurance is sold? The answer is yes. Or is the idea a conflict of interest exaggerated? I don't necessarily think it is. I actually agree that there's a lot of problems with this. What should consumers ask before buying? I agree that there's problems, and if you look at a lot of people in their issues with insurance, probably a lot of it had to do with improper education, maybe some incentives, maybe some conflicts. But I think it really just comes back to, I don't care how much you're paid. I care about, am I doing the right thing for me? And I think that's where we just need, so it's like consumers need to figure out how they can come to that conclusion. And Jim obviously has a great solution for that, is like, hey, pay our company and we'll be a client of ours and we'll help you do that. That's great. But if you don't do that, then like there's even like getting a second opinion. I think getting a second opinion is great. Just make sure that the second opinion is actually understands insurance. If insurance is, let me rephrase that. Make sure that they understand insurance. So whether they're telling you to buy or not to buy, or advising you on like what tweaks you should make, they're actually making it through the right lens. And I think that's where my problem is a lot of people are talking about insurance and they know nothing about it. And they're calling it a scam. They're talking about all the same Dave Ramsey talking points. And that's what's frustrating. It's just like, I just want a fair, like, I just want an actual apples to apples comparison, not someone who's like already thinking that this thing's a scam. Like, oh, gee, I wonder what they're actually going to tell you. If you go to Dave Ramsey, like, hey, what do you think of this thing? Is Dave Ramsey actually even going to look at the illustration? No, he's going to tell you, don't do it. That can be irritating sometimes.
Yeah, no, I agree. And I think when you're buying something, there's 2 ways to look at it. You either just buy it because somebody that you trust has told you to buy. And so you're like, hey, Caleb, you should go get this thing. It's worked for me. Like, trust me, like, and you trust my opinion. And so you just get it. You put less attention into asking the questions that are even needed. Or you spend all the time educating yourself. So you become an expert relatively, especially the higher the cost or the risk or the consequence of failing. You need to spend enough time doing your due diligence to find out what questions you do need to ask, and then making sure you know what it is that you're hoping from a response back from the person that you're asking them from. And usually you can probably not even need to ask the questions if you know enough. You just be like, hey, like, let me see, like, let's have this conversation. Let me see the illustration, making sure that it goes to the fine print. And you can get whatever it is that you want at the end of the day if you know enough. So if people are trying to have to ask these types of questions and they're like in the scam mode headspace, like, they should just not even get it yet. Like, they should just like completely turn away from it until they go down a rabbit hole of figuring out what it actually is.
Agreed. So, cool. Okay. Last but not least, this question is trade-off.
Finish in 7 minutes and go underneath an hour? That would be crazy.
Don't jinx it. Is the trade-off. Term is cheaper but might pay nothing. Whole life costs more but builds value. How do you honestly weigh the trade-off? I think to be fair, I don't like that argument because it should be opportunity cost of anything. Like, yeah, term might not pay anything, but the investments that you're building up have value. And so I think it just goes back to the you need to weigh both things. Yes, term is a pure cost, hopefully. But the argument is the investments will far outweigh the permanent life insurance. And so I'm not going to swing at this. I'm just going to use the same answers. Like, I don't know, but we have to factor it in. And I stand by the concept of if something can make it better, you should do it. And if something can't, you shouldn't. It's definitely something that you need to think about, is like, you're buying life insurance that's so expensive, but you're guaranteed to die. You're literally buying a contract that's going to pay upon your death. So it's not like you're throwing that money away at no, like, it's like, is my house ever going to burn down? They're like, you're going to die. And so like, there's value built into that, but there's also a cost. Like, long term, if you die at age, 100, the ROI of your death benefit is an equivalent of maybe like 4 or 5%. Well, someone could easily say, even with the cost of term insurance and dropping that, I could earn 6% over my lifetime and get a greater step up in value add to my heirs. So that's a valid point. So that's where you just need to look at other things of what you're doing with that. But I will say, like, over 80 years, if you can earn 5 or 6%, some people might be rolling their eyes, but like, it's pretty good. It's pretty good to like have that built-in guaranteed. We're not talking about the cash value, ladies and gentlemen. We're not talking about any of that. We're just literally saying like your legacy value, if you live to a really, really old age, guaranteed 4 to 5%, maybe 6%. And oh, by the way, if you die prematurely, the ROI is a lot greater, but it's not, no one's going to be rooting for that. I really want a great ROI on my death benefit. Well, I hope you're not rooting for that.
Yeah. I think what some of the people that we look at to the space that have done a lot of the amazing research, like Wade Pfau and Tom Wong, people like that, is the argument would be that you're eliminating volatility and risk because we have no idea what happens in a lot of ways. Like, I don't know if I'm going to die tomorrow. I don't know if I'm going to die 30 years from now. And if, Jim Du's philosophy is eliminate as much risk as humanly possible to create as much certainty as possible, then a permanent death benefit is one of the easiest, safest, fastest ways to do so, to where you don't have to worry about like, am I going to actually build enough wealth for my family to self-insure one day? Maybe, maybe not. Maybe you get hit by something and it ruins everything. Maybe you can't work and you didn't have disability and therefore like income just changes drastically. I actually have no idea, and neither does anybody else. And so by putting in the tools and the pieces in place as early on as possible, eliminates that risk to go, 1, to bed at night, to sleep better, and 2, allow you to show up better because you're not stressed out about like, well, what could happen? You're like, it's already in place no matter what happens in life. So
yeah, I love it. Well, guys, thank you so much for just being behind the scenes. There's nothing that Dom and I changed in how we spoke to each other. Like this was really helpful, Dom. Just going through this, talking out loud. Again, we will put the links down below, or stay tuned. Maybe you're watching this and they haven't published yet, but I think it will be a great. And regardless of how, maybe I just totally flop. Like you go and you're like, wow, Caleb, where like you missed all the talking points. That could happen. Make sure to be super respectful in the comments. And it is like, it's really actually cool that out of all people that they could have chose to represent the insurance side, they asked me because they know lots of amazing players in the space. So it's cool. I hope to represent us well. And hopefully people can see both sides, because I think that's the power of these conversations is, Caleb, you made some good points. Jim, you made some really good points. My financial IQ is greater because of this conversation. That's ultimately is the goal. There's really no winning or losing. It's are people edified and increasing their financial IQ through the process.
Mic drop moment right there. It's a great way to end it.
Cool.
All right, guys. Well, thanks again. Leave the comments below if you liked it or not, and tell us that Caleb is wrong in all things arbitrage. And no, I'm just kidding. Anyways, until next time. If someone
wants to debate me on arbitrage, let me know. I will have you on, and I would love to hear your thoughts, because you might show me something in math that I've never seen. But yeah, we're always a student. So thanks, Dom. We'll see you next time.
I only went for a day, and that was my biggest regret, because people start to see something in themselves they haven't seen before.
I'm just so grateful.